next session of the AI Frontiers in Finance webinar today. So this is the second to last one. We have next month again, and then we have our summer break, so to speak. So today we're going to have an absolutely interesting topic. And before we dive into that, we're going to have a few housekeeping things I want to make you aware of. Basically, people who have visited this know about this. First thing I need to say that we are going to record the webinar again, as always, and the recording will be available on YouTube in a couple of days' time, which of course will be linked also to our website. Again, so who is organizing this? We have started this together. Birgit Frankenberg, who is founder and managing director of HighPeak, which is a consultancy company here in Frankfurt. Paulina Fairhoff is a PhD student here in Frankfurt, also working on topics around this whole AI and finance frontier, and myself. And the broad idea that we had when we started this last week was to basically bring this sort of idea about AI and finance together, both from an academic as well as from a practitioner perspective, because everybody kind of talks about these things, but also there's always a sort of like black box in between. How do these things work? What's its practice? What are the best use cases? What are the best top methods actually for each use case? And there's so much development in that, but also many new use cases applied in the finance literature. So we said, look, that's actually a pretty good topic and perfectly fitting also to our Center for European Transformation, where sort of this, how does AI also transform the way we work, the way we make decisions, plays a huge role. And particularly also in today's paper, again, this has a huge role as well. The idea is, of course, to have this as interactive as possible, so you can get involved at every stage, so to speak. If you have a technical problem, please email to our email address, aifrontiers@fs.de, and then we can help you. And if you have questions regarding the topic and you want to bring in some thoughts, use the Q&A button. So you should not use the messaging one, because this will only be seen by very few people, but the Q&A one will be seen by everybody, and all your fellow participants can also vote up if you wish that some questions are particularly interesting. So, and then we're going to, everybody from us sees that, and then we can bring in the questions along the way when we discuss the topic. So this brings me also directly to the topic of today, and we're very happy to have Tony Cookson here today from Colorado University to talk about a topic called market signals from social media. And Tony, if you look at his CV, he's a very well-established academic in the US. He got his PhD from the University of Chicago and works particularly on topics related to how do firms make decisions, how do households make decisions, with a specific focus also on these social media platforms and information we can get from there. Besides his academic research, of course, he's involved in lots of different editorial roles as an editor of the Review of Corporate Finance Studies, but also associate editors of the very top journals that we have in our field, the Journal of Financial Economics as one example, but also Management Science. So I think before we dive into the presentation, what I wanted to do, as always, is to do a quick poll. And let me just stop sharing my screen and start with our poll. Again, a couple of seconds on the clock. Everybody should express his or her opinion. And the question is, how much do you believe social media signals like sentiment on Twitter or StockTwits can reliably predict short-term market movements? So they're very reliable, offer some predictive insight, but be caution, they're mostly noise with occasional insights, and they have no real predictive power. So let's see what everybody thinks about that. Okay, a few more seconds for other people to make the decision. And let's close it. Let's see what we got here. So I hope you can see the results. So 15% very reliable, the majority 70% offer predictive insights, but with caution, 15%, mostly noise, and no one is convinced there's nothing to be gained from looking at this. So first of all, before you hand over, Tony, is this sort of what you expected or what you normally get from people when you talk to them?
I think this is a shift from when I started working on this. I think more people would have said they have no predictive power when we started working on this, and I think this is certainly is in line with my expectation. It's about where I think the audience should be.
Awesome, perfect. So let's see whether people get more and more convinced about sort of how reliable these predictors are. Let me close that, and then I hand over to you. Thank you so much for being online. We very much look forward to what you have to say about social media as predictors for stock returns.
Right. Great. So should I start? I should start sharing. Okay, great. Cool. Thank you for that. That's a very interesting introduction with the poll to see where everyone is thinking. This is actually we've been working on social media research for quite some time now. Marina and I think first started working on our disagreement paper almost 10 years ago. So I think this is sort of unexpected to see sort of a research trajectory with such a long trajectory. This paper is joint work with Runjing Liu, Marina Niesner, and Will Mullins. And let me start kind of with the motivation. So, motivation for this paper is that market signals are of major interest. At least sentiment. There's a huge literature that has emerged after sort of Baker and Wergler did their work. But one of the main reasons for this is that this is a testing ground for updating models. It's a setting in which we're sort of thinking about sort of what is sort of in driving kind of macroeconomic outcomes as well. And so we think that this is an important sort of setting to sort of understand the nature of, say, market sentiment. And certainly events this week and this month sort of highlight this as well. Yet, when you look at the measures in the literature, many of the measures are lower frequency. And despite the fact that we sort of get the sense that people update frequently, daily, maybe even within daily, and often sentiment is a mix between sentiment and attention. You can just sort of look at like the components of the Baker-Wergler index, and you kind of get that impression as well. The other aspect to motivate this project is that social media is kind of increasingly a primary news source. I think the poll kind of indicates that people place value and weight on some of these signals from social media. But from our perspective, it's a natural place to look for things like animal spirits. And when you think of animal spirits, you think of like sentiment. And also from our perspective, it's a setting that allows us to actually separately look at sentiment, that is kind of the optimism or pessimism about the market, versus attention, which is kind of the volume of activity and sort of checking in on what's going on with the market. So kind of what we find as a high level in this project is we're going to develop market-wide measures of sentiment and attention. And we're going to find that both negatively predict market returns, yet the return dynamics are distinct. So sentiment's negative prediction looks like a within month reversal after sort of a very short-term run up. So sentiment seems to be sort of driven up in the after sort of recent market rises or driven down after recent market falls. And attention sort of actually exhibits a very distinct dynamic. It looks like a continuation of negative returns. So there's sort of an emergence of attention that sort of looks very different. We put this into a dynamic trading strategy, and really just to kind of give a sense that this isn't kind of reflecting kind of forward-looking information. We see that there really is some economic content to this. We also see that sentiment and attention are distinct in other ways. So, for example, they have an opposite relation to aggregate trading. So, low sentiment predicts sort of higher turnover in the S&P 500, while high attention predicts higher turnover. So we see this distinction actually between sentiment and attention runs through all of our results. And then when we look at what drives this market-wide sentiment and attention, we actually find another decoupling. So we see that there's a strong connection between returns and sentiments. It looks extrapolative. And there's a strong connection between trading and attention. And it's that's kind of the axis on which sort of market outcomes seem to relate to sentiment and attention. One thing that we find that's a bit surprising about this kind of extrapolative relationship is that the extrapolative relationship seems to actually be primarily from the negative side. So we see that negative jumps seem to drive sentiment down and attention up. And similarly, like when we see spikes in market volatility, sentiment goes down and attention goes up. And these are actually kind of two distinct aspects of our results. Yet when we sort of look at like the positive jumps, we see very little responsiveness. So like I think way to think about our return extrapolative result where returns predict sentiment is actually it's really the negative returns that drive sentiment declines and not so much positive returns that drive sentiment rises. So we think like there are several reasons why you might sort of think of this paper as distinct from things that have come before it. From one perspective, we provide daily measures of these market-wide sentiment and attention, sort of higher frequency than sort of the usual measures that vary monthly. And the fact that we distinguish between sentiment and attention just is not just like a sort of an econometric thing, that we see actually a pretty distinct imprint of our results when we look at sentiment versus attention. So we think that those distinct patterns should be of interest. One thing I'll emphasize is that all those results that I've sort of highlighted, they all hold within month. These are really actually higher frequency updates, and we think that that's another distinctive aspect of our results. The extrapolative result we think is also kind of interesting because there's this literature on extrapolation, and I think a lot of it thinks about it as a way to support bubbles. But to get an extrapolative process to support bubbles, you really have to have sort of positive sentiment updates after positive return jumps. And we're actually seeing the relationship being driven by negative jumps. So we think this is an interesting challenge for the literature. And then kind of finally, in terms of where to place this, is we think we're sort of one of the first sort of comprehensive studies with an aggregate focus, within social media. So social media, as you'll see, a lot of the information is at the firm level. And our contribution within the social media literature is to sort of aggregate this to the market level. And we think that this is novel and provides kind of a useful sort of jumping off point. So now let me just kind of go through in more detail kind of how we kind of reached each of those points, and I'll show you each of the results in turn. So this paper is fundamentally about measurement, and then kind of once we've constructed the measures, they're fairly simple tests that we can mostly display graphically. So I'll describe kind of in 3 steps how we construct our sort of market-wide measures. We actually start from a pretty generic standpoint with firm day data on social media activity. We look at the 3 major social media platforms for sharing investment ideas. These are StockTwits, Twitter, and Seeking Alpha. And for each of these, we get sort of firm day or message level information. So for StockTwits and for Seeking Alpha, we either get tweets or articles that are written about particular firms at a particular point in time. And for Twitter, the company Context Analytics, who shared the data with us, gave us a daily signal for attention, which is basically the number of messages that were posted in the previous 24 hours. And they also gave us a daily signal for sentiment, and we're just going to kind of use those signals to construct our tests. So what we're going to do is for each of these platforms, we're going to construct an attention measure, which is just the number of messages or articles that are posted about a firm on a given day. And we're going to construct a sentiment measure, which is the average sentiment sort of scaled between -1 and 1 by firm day. We need a sample restriction so that like the sentiment measure is any good. So we're going to restrict to firm days that have enough activity where we can see sort of an average with some reliability, at least 10 messages. As you'll see, when we go to the aggregate measure, we're going to aggregate by aggregating by the market capitalization of the firms. And so this restriction actually doesn't have a whole lot of bite. So next, one of your questions might have been, well, these are firm day signals. Aren't they mostly about the firms? So what we're going to do is actually do an initial purging of the firm information from each of these signals. So for each signal, what we're going to do is regress it on news. Traditional news from the Dow Jones Newswire, whether there were 8K filings or earnings announcements in the recent week. And we're also going to control for the firm's average signal in the prior year. So for attention, we'll look at the average number of messages in the previous year. For sentiment, we'll look at the average sentiment in the previous year. And so if you think of people who are just really bullish about a particular stock for no apparent reason, we're going to account for that kind of average bullishness about this stock. And the reason we're doing this kind of lagged version instead of fixed effects is to sort of give us a way to do this so that we're not conditioning on future information in these regressions. The next thing that we'll do is we'll kind of purge this yellow part, and that'll give us the residuals for each signal. So for sentiment, for StockTwits, sentiment for Seeking Alpha, sentiment for Twitter, for each firm and day, we'll have a residual. And what we'll do is we'll aggregate these residuals to a daily measure by platform by just kind of taking the market cap weighted average. So in this case, Apple will get much larger weight than say GameStop. And this I think is important for thinking about the content of our signal, is that we're trying to describe kind of the market sentiment. We're not trying to describe say sentiment about sort of smaller pockets in the market. So when we do this, we're able to sort of see this table kind of provides the sort of the evidence on the purging regressions. We don't, because we have a lot of firm news controls. We kind of put that into kind of the footer of the table, but you can see that like this really does actually explain some variation, but there's a lot of residual variation. So you see like for the sentiment regressions, even controlling as flexibly as we can for news and for say StockTwits, Twitter, and Seeking Alpha separately, we have like 90% of the variation is kind of this idiosyncratic piece. And so if you actually look at the sort of, when we then aggregate that to the firm or to the daily level for StockTwits, Twitter, and Seeking Alpha, we then put them together into a single index for attention and a single index for sentiment by just constructing the principal component, first principal component of those three signals. And you can see that the first principal component of the sentiment signals is kind of mostly just averaging StockTwits and Twitter and Seeking Alpha. Seeking Alpha gets about half the weight as StockTwits and Twitter, whereas with attention, it's kind of mostly just StockTwits and Twitter. And you can see that this kind of captures the most sort of relevant dimension of sentiment and attention, and sort of these are the indexes that we then sort of proceed with. So how does this look? Does this actually capture sentiment? We actually think that it does in sort of useful ways. So there's some daily indexes out there for retail attention. This is sort of based on Google searches, institutional attention based on sort of looking at information lookups on Bloomberg about particular stocks. There are also these kind of attention indexes drawn from the Wall Street Journal or the New York Times. This is a economic policy uncertainty index. And then this is a news sentiment index drawn from Ravenpack. Now, these are the sentiment indexes, and these are the attention indexes that are at the daily level. And we're just doing a regression of our sentiment measure on these indexes. And I want to sort of highlight a couple of things. One, if we don't sort of include anything except for these other daily indexes, most of the variation is not really predictable by these other indexes. But there are sort of statistically significant relationships. So in particular, if you look at the economic policy uncertainty, more economic policy uncertainty is sort of related to lower sentiment by our index. And we think that that's sort of a very natural correlation. And as we kind of include extra controls, so controlling for our attention measure, controlling for day of week, month of year, and year quarter fixed effects, you can see that like the most robust relationship in this table is that kind of more sentiment link between more uncertainty is kind of more sort of less sentiment. And it's a pretty robust relationship. I think the other thing to kind of point out is that social media sentiment, according to our measure, is not just capturing sort of aggregated news sentiment. This sort of is part of our construction that we sort of residualized by whether there was news about these firms. And so we think that this sort of shows that residualization step actually allowed us to construct something that was more distinctive of social media than of media in general. We turn to our attention index, you can see that like the most robust relationships that we see are between retail attention and institutional attention. Actually, both of them load independently on our attention measure. But what you see is that the retail coefficient is actually much stronger, like twice as strong in kind of the most enriched specification. The other thing to point out is that sentiment and attention in our tests are negatively correlated, but like even like they're not capturing the same phenomenon. Even when you include sentiment as a control for attention, you don't really explain sort of much of the variation at all. You're really only getting an R squared in this sort of second column with all those other indexes of like 24%. So we think that sentiment is capturing something distinct from attention and vice versa. And they're also sort of loading in sort of meaningful ways on these existing measures while having a lot of residual variation unto themselves. In the time series, we think that it kind of captures, if you sort of look at the lower frequency variation of our data, you can see this sort of period of a bull run where there was sort of relatively high sentiment and lower attention. You can see kind of the first instance of US-China trade war. There was sort of high attention and low sentiment. You can see the onset of COVID is that there was high attention and there was low sentiment. And so like this sort of picture we think actually provides like a kind of a nice validation that like what we're capturing is reflecting kind of what's going on in the broader market in terms of sentiment and attention. And there's lots of high frequency variation here too. So the lighter series are actually the daily series where it's a little harder to see kind of these links to the events that you can identify in the time series. But the focus of this paper is actually going to be looking at some of this higher frequency variation, which has very interesting dynamics within month. So let me kind of turn to the return results and kind of highlight how these indexes relate to returns. And the return results, I sort of like this picture where we look at a cumulative return from 5 days before to 20 days after a one standard deviation shift in sentiment and a one standard deviation shift in attention. So here we're just sort of looking at the outcome variable is like, what is the cumulative return from sort of 5 days before? And you can see that there's this and the variable that we're explaining is we're using to explain is sentiment as of date zero. And so for each of these, each sort of column of results here, so -5 would be the return 5 days prior to standard deviation increase in sentiment. And then you can see that like sentiment seems to correspond to a run-up of returns prior to it. And then there is this kind of reversal that happens over the next 20 days, whereas attention seems to exhibit this sort of decline that exhibits that happens before attention rises. And then there's kind of a little bit of a continuation the next day and not much thereafter. We see this in sort of our regression tables as well. Sort of the quantities that we see are as of 15 days after. There's about a 38 basis point reversal for a standard deviation increase in sentiment. And for attention, the next day, there's about a 6 to 7 basis point decline that is a continuation of that prior trend. We really don't see much difference when we include year-month fixed effects. This picture is using year-quarter fixed effects. Now, obviously, when we're using kind of the year-quarter or year-month fixed effects, that's sort of potentially conditioning on sort of future information. So what we do is we do a trading strategy in which we sort of estimate kind of the relation between sort of today's returns or today's sentiment and attention and tomorrow's returns. We sort of use that to construct sort of a trading strategy in which we sort of put more or less into the market portfolio. What we find is that the strategy and we do this kind of in a rolling window sense or sort of an expanding window sense. We start from the beginning of our sample and expand out. What we find is actually a pretty consistent, pretty robust prediction of 3 to 4.6% annually and a cumulative gain of about 50% over our sample. This isn't explained by the sort of the usual risk factors, and so we think that this isn't just kind of conditioning on future information, but actually capturing a signal that has actually predictive content for returns. I think the other aspect that we want to emphasize is that these signals are not just related to returns, but they're also related to trading. Actually, the distinction between sentiment and attention holds here as well. So for a standard deviation increase in sentiment, you actually see a pretty distinctive decline in trading volume over the next 20 days. And this is accumulated trading volume. Sort of like we were accumulating returns, we're accumulating trading volume in this plot window. And here is kind of for a standard deviation shift in attention. You can see that like attention seems to rise after there was sort of a rise in trading volume, and it continues to rise thereafter. And so we think this sort of distinction between sentiment and attention, yes, they both predict negative returns, but high sentiment predicts sort of lower turnover, whereas high attention predicts more turnover. And so we think that that distinction is actually pretty interesting in our view as well. So here's kind of the table that highlights this, kind of shows the statistical significance and sort of the different specifications that we include. One of the things you might sort of have wondered is if don't sentiment and attention potentially interact? Actually, in most of our tests, we don't really see a very significant interaction between the two. We see that they're offering distinct dynamics, but their interaction doesn't seem to be particularly striking. this result is robust to controlling for year-month fixed effects and also any of the other aggregate attention indexes. So you saw in that sort of validation table that that retail attention and institutional attention were statistically related to our attention measure, but they really don't explain sort of the turnover dynamics that we see. And so we think that this is that we're offering something sort of beyond just the attention that you can infer from Bloomberg or from Google searches. So now I think the next part of the paper, and I think the part of the paper that sort of has kind of more economics to it, is to try to understand what drives sentiment and attention. We have several tests that kind of speak to this. One, we sort of do, because we're sort of in an aggregate setting, we think it's natural to sort of think about, well, what's sort of the impulse response, and sort of use this as a way to kind of capture the dynamics of attention and sentiment in response to sort of spikes in return or trading. And so here, what we've done is we've estimated a vector autoregression with 10 daily lags of attention, sentiment, returns, and turnover. And then we're just evaluating, like, well, what does a shock of a 1 standard deviation increase in return sort of do to the system? So you can see here's in the first column, you see a 1 standard deviation shift in return. And you see that, like, sentiment spikes actually significantly and for several days when we sort of do this 1 standard deviation increase in return. Now, this is set up as a continuous variable. So like it would be the same as if I said a 1 standard deviation decrease in return. You would see sentiment decrease for a while and then kind of come back to normal. I think that's something that's important to keep in mind before we move on to the next result. The other thing that we see is that we see that, like, a standard deviation increase in turnover, you don't really see much shift in sentiment. But one thing that you do see is if that increase in turnover is market-wide turnover, you see that attention, it remains high actually for several days. And so we think, like, this is kind of the sense in which, like, attention seems to be linked to lag returns, whereas turnover seems to be linked sentiment seems to be linked to lagged returns, whereas attention seems to be linked to lagged turnover. Now, let's dig into that return result and try to understand, like, is this coming from positive versus negative aspects of or jumps in the market, movements in the market. So what we do is we collect a list of days where the market goes up by 2% or more, and those are our positive jumps. And you can see that, and then we just sort of look in an event window around those positive jumps and ask, well, what happens to sentiment around those positive jumps? In this first column, you see that, or this first panel, you see that really nothing happens around those positive jumps. And I think that's actually a pretty compelling null result, because if we do the same thing for negative jumps, you see that sort of nothing happens before the negative jump, but then the sentiment declines significantly and remains low for several days. Right? And so what we infer from this is that, like, the negative jumps are actually a pretty major driver of sentiment, and that there really isn't much being driven by sort of the really sharp positive movements in the market. Same thing happens for attention, by the way. If we look at attention around positive jumps, we see an event window with really nothing going on. Whereas we look at attention around negative jumps, you can see a pretty reasonably flat pre-trend. And then the day of, and maybe the next several days, we see higher attention. So we see around negative jumps, sentiment declines significantly and remains low. Attention increases significantly and remains high. And so we think that this is actually a pretty sort of a pretty striking finding on this asymmetry, and we think it's what's sort of driving sort of the sentiment and attention movements in kind of the broader sample as well. What we see is actually similar results when we look at positive spikes in the VIX, which are analogous to negative jumps in the market. We also see that this isn't driven by like scheduled sort of macro news days. So we think that this seems to actually be kind of more kind of spontaneous market activity. Last thing I want to leave you with is that you may kind of be wondering, well, where does this aggregate sentiment come from? And we have this kind of test in the paper where we try to think about like how sentiment propagates across real networks. There's this really nice, really wonderful paper about the data economy by Bian et al., where they measure centrality in the sort of information that's shared company to company by the apps that are on your phone. And so typically or sort of historically, we should say, your sort of phone apps would collect information about your activities, and then they would be shared actually because you sort of were opted in by default to sharing this information that could then kind of be used and monetized across various firms in the economy. Bian et al. Sort of look at the sharing of this information and link firms, and they actually measure the centrality of firms in this data sharing network. This was actually a very valuable source of data for these firms. But the interesting thing is that they find is actually that there was this Apple tracking transparency policy that came in April of 2021 that just completely shut this down for the Apple data sharing network. So they generously actually shared data with us on their actually 20 most central firms across different centrality measures. And so what we did is we just computed a superset of all of those and took those ones as the central firms. And we computed central firm sentiment and attention, basically just aggregating by market cap within central firms, and then just kind of asking, well, how much does central firm sentiment predict sentiment overall? And more importantly, how much does that central firm sentiment's prediction of sentiment overall depend on whether it was before this Apple tracking transparency versus later? We're expecting beta 1 to be actually strongly positive, that sentiment of central firms should predict sentiment overall because those are important firms. But if like this is actually propagating across this real network of the data economy, we're actually expecting beta 2 to be sort of negative. So to kind of that this relation between the central firm sentiment should weaken after this policy comes in. And that's actually exactly what we find. So when we look at overall sentiment, we see is that there's a very strong relationship between central firm sentiment and overall sentiment. Before that Apple tracking transparency turned this data sharing network off. But then after that data sharing network was turned off, you see actually a very prominent weakening of this relationship. So what we sort of conclude from this is that sentiment seems to actually propagate across firm networks, that firms that are connected in sort of real economic ways, that sort of optimism tends to kind of spread across those, that optimism isn't just kind of a firm specific thing. And we're sort of aggregating this kind of optimism that's shared across firms. Interestingly, that's not kind of the origin of attention. And attention seems to actually kind of bubble up from sort of all pockets of the market. So from the standpoint that like central firms seem to actually be related to overall attention, but it's really just because it's attention that is kind of generically out there, and it's not something that propagates across firm networks. So again, just like sort of all the other results, we see a pretty striking distinction between sentiment and attention. So that's kind of what we have in the paper. We developed new market indexes of sentiment and attention. Sentiment and attention are distinct. They don't seem to interact that much, but they're distinct in terms of how they relate to returns, how they relate to turnover, and they're distinct in terms of what sort of drives them, returns versus turnover, and they're distinct in terms of like their network propagation dynamics. So we think sort of all of these sort of point to there being some value to sort of using this setting to distinguish between sentiment and attention. We think there's a lot more sort of interesting things to examine, but I'm really interested to hear what Sasha's discussion is and to engage with everyone's comments. So thanks.
That was great. Thank you so much for presenting this. Let me share. I have a couple of slides myself. And before I do that, maybe I would like to encourage everybody sort of to, I think this is, as you said, it's such a vast area of research, so to speak. There's so many questions you might want to ask. So please go ahead and put your question into the Q&A box. Let me share my screen. So I think you should see that. Now you should see the first slide, right? And so I don't want to give the time that we have left. I don't want to spend too much time on that. But I basically made that slide because for me and sort of my modest reading of that overall asset pricing literature is that exactly that's one of the key contribution actually of the paper, because there's a lot of research on sort of what are good predictors in asset pricing for stock returns, for bond returns, or loan returns. But usually there's sort of, as Tony said at the beginning, they kind of mix these sort of ideas of sentiment versus attention together. And this is an interesting attempt and a very good attempt to actually show how distinct these two indices actually are and what also the differences in impact actually is, right? And I thought this kind of overview shows is quite nice because how different they are. One is sort of kind of the impact of return of the sentiment index, which seemed to be more like reversing over time after a huge decrease of returns, while the market attention, for example, shows this continuation of negative returns, right? And even that appears to be a little bit different. So at least what I know from this literature is that there is sort of the positive spin on attention. People jump on there's something good, and then sort of their attention actually increases returns going forward. Here's actually the opposite. So it appears to be there is some bad news, and then people just jump on and they start selling, and then actually this leads to actually lower returns, right? So this overall idea of separating this out with all of these different effects was actually a very interesting contribution in my point. And based on what Tony also explained, they have basically hit the most interesting or important points in the paper already. So what I did is basically I structured my view around three key topics. One is sort of a bit more the overall economic and theory of interpretation of it all. One is sort of how can we actually use that in practice? And then a little bit sort of like around the edges a bit on the methodology side. Yeah, and what we're going to do, I'm going to start with the first aspect, talk a bit about that, and then leave some time for Tony also to respond to that. So given that I'm in corporate finance or a person, so to speak, my view is always to jump on sort of like the mechanisms, right? So it's always nice to see that there are some indices and indicators that kind of predict what's going on. But I think it's always good to know why it's actually happening, right? And I think Tony and his co-authors already attempt to do something, but I think here it might be more interesting to actually go a little bit beyond that, right? So specifically the question, sort of is sentiment, is attention actually causing market movement? Or given that they're kind of reflecting increasing in past returns, for example, do they sort of piggyback on that? And then sort of what they're actually measuring reflect other factors here, such as these recently high returns, right? So I think the basic point would be to kind of show what's actually happening. How do these signals transform into returns? What is actually happening in terms of trading, and how is this influencing trading behavior? So this was my first idea when I read this paper. The second one was actually, what are we measuring here actually? So is this an anomaly, sort of more like behavioral story that what the authors have in mind, I think, or is this more like a risk factor, right? So they have, as Tony said at the beginning, they have, and this appears to be, I think, high given that it's publicly available social media data, a Sharpe ratio more than one, and in return that appears to persist. So the question is, if 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 investors and also institutional investors are seeing that, and this sort of has implication for positive return, why is this not arbitraged away? What are sort of the limits to arbitrage, the frictions that prevent investors here from actually reducing these returns over time? Or is this basically not an anomaly, but it's actually a risk factor? So it's actually some kind of risk premium that investors actually require for their trading. And then what might be these fundamental risk factors is some sort of volatility that's being priced. And then the third one in that area is, what are sort of the broader implications of the paper? Do you guys think that social media actually makes the market more efficient by producing more information, or is it actually increasing volatility? I think these are the three issues I wanted to raise here. So, Tony, I'm handing over to you.
Yeah, I think these are sort of very useful reactions. I mean, I think I've always thought of this as like sentiment and attention are reflecting these movements, and I think it's sort of useful to sort of see how they reflect this. But I do think that because it's the social media setting, both like these questions about mechanisms and causality and broader implications come up, and I think we haven't thought as much about like is this sort of driving things. Mostly because we're thinking about this as like, social media revealing sentiment and attention. And it's revealing a different aspect of sentiment and attention than existed before. It's an interesting reaction on the anomaly risk factor piece. We do have in mind to sort of grab sort of more sort of rational sentiment indexes as a benchmark as a way to sort of think about this as well. But I think it's helpful to sort of think more deeply about this as well. And so we appreciate the nudge to keep our learning journey on that dimension too.
Okay, I think we have a few comments also from our audience. So one example, or one question is, so let's take the example of the last few days when we first had negative market shock related to US tariffs on Thursday, which was followed by a short-lived positive news on Monday that the US tariffs might be reversed. How does this type of positive news in the overall negative context impact the sentiment and intention index?
Yeah, so one thing I didn't go into in as much detail is that when we look at an event like this, we take the first event, the first starting point. So like there may be like 3 or 4 market jumps in like the last 4 days in the U.S. markets, right? So where you saw like the big movement down on Thursday and on Friday, we would only have counted Thursday. And I think we would only have counted Thursday for this entire event. So I think like I think from that standpoint, like to the extent that like big negative event tends to be followed also by general like malaise and sort of worse events and deepening of that. I think that might be part of why we see some of this persistence. At the same time, like we generally, if we're looking at a positive event, it's a positive event that came kind of out of nowhere. That the market goes up by 2%, and it wasn't that it just followed the market going down by 2%. So all those sort of days in early COVID where the market went down 9% one day, then up 9% the next day, and vice versa, and just kept going like that. We took the first event, which was a negative event, as sort of the starting point. And so I think like maybe that gives you sort of better context for sort of what we're picking up on.
Okay, perfect. So let me maybe go on. It's a little bit sort of related to this point maybe, but also given that it's a bit more also on practical and sort of the academic, oops, hang on,
Mm.
side. I had two questions, particularly related to the implementation, and um, in order to, for example, because you have that part in the paper where you start talking about, okay, what are possible trading strategies that you could actually do, right? And my thought on that was, okay, what is sort of the economic significance of the strategy vis-a-vis its practical implementation? I was thinking about how I would do that if I was a practitioner, right? So what kind of data would I need, and how could I actually execute that, right? And it seemed to be that, but maybe you have a very different view on that, that execution of such a strategy might be relatively complex, starting with data acquisition from the different social media platform, processing the data, using the information from that to execute the trading strategy. So that might be the given specifically that the returns that you generate from such a trading strategy, also what the previous literature has shown, is usually relatively short. You have the positive return on the same day or maybe on the next day. So it appears to be able to do these things rather quickly, right? So how how large, economically large, might then sort of that type of impact of such a sentiment indicator actually be, given kind of these possible frictions? And then the second and related point is that what about transaction costs, right? I think you kind of ignore that. But the overall strategy that you have in mind has a high turnover in terms of shares, the adjustment of position based on these news, and so on. So if there are transaction costs, illiquidity of stocks, high bid-ask spreads and the like, other types of transaction costs, is there any kind of way of telling that? How would these sort of like gross returns that you think about in the paper, how would this then sort of compare to net returns after accounting for that?
Yeah, I mean, I think these are definitely fair points. I mean, it is we are kind of aggregating sort of across multiple platforms. It's fairly rare data. I mean, I guess like some of these signals are becoming kind of more marketable as time has gone on, but they weren't so marketable earlier in our sample, right? And so I think like from the standpoint of like this, like it sort of takes a lot to kind of build up this machinery, and we have a fairly short-lived strategy that does kind of require sort of updates. You know, in the paper, I think it's in the appendix at this point, we should sort of show that like we don't sort of end up in like really costly to take positions in this strategy. So like we don't end up like with positions that take leverage very often or needing to be short the market very often. It's actually usually an internal solution. And so we also sort of implement a version that like kind of rolls through like the average of the last 5 days, and it doesn't like deteriorate the performance too much. And so I think one of our inferences is that like that the sort of the trading piece isn't as much of a burden as we were expecting. That said, I do think that much of the headline number is going to get eaten up by like transaction costs. Like this is a daily strategy. There is sort of turnover. We haven't sort of found sort of a way to, we haven't implemented a way to sort of account for that, to net that out. We think of that more as a feature of our analysis, and maybe a sense in which this is sort of more realistic, is that this would be hard to implement. If it were easy to implement, I think that it would strain the credibility of it as well. So I think, you know, as a good Chicago economist. I think I need to recognize that markets are mostly efficient. There you can find a way to around trading costs, and if you're sort of someone who can sort of execute these strategies at scale, this becomes maybe more feasible because then transaction costs become sort of less of a deal. But I think that would be my perspective on this, is that like this is something that would not be sort of something I could personally implement. But I do think that it'd be something that requires machinery, data acquisition, and then you end up at the margin getting rewarded from that, but rewarded commensurate with the effort that would go in.
Okay, so I think we have a question that relates specifically to the a little bit more to the modeling part of things. So when was the static model last time reviewed? For example, with the current dynamics, could the dependency increased?
I'm not exactly. I guess I could use some clarification on like what it means by the static model. Is this the model for sentiment, or like I'm not. I don't know if it's possible to clarify.
Okay, yeah, maybe the whoever posted this, because it was an anonymous
Yeah,
participant, so to speak,
right. Yeah,
can provide a little bit more context. And in the meantime,
right.
we have only 4 more minutes, and maybe we can
Okay, sure.
talk about a couple of more things in between. Otherwise, we come back. Just a few things. Maybe you can talk a bit more on the on you discussed this in the paper, but maybe you can think a bit, or you can talk a bit about this here as well. So. Possible sample bias, and this comes also. We have a paper on where we use Twitter data and an inflation index, and also develop other indices based on other data. And one question that always comes up is a sort of, are we limiting ourselves? Is there sample selection bias in the sense that it's usually the sample usually is comprised of a very specific set of firms. Here, in this case, that social media pays attention to very popular and large firms and underrepresentation of like small firms. And to what extent then is this basically telling us something about the market at large, but rather about a very specific segment of the market? And would it be maybe possible to kind of use your aggregate index and do, for example, like two aggregate indexes, one for large firms, whether it be small firms, and see whether they sort of like behave different as to predicting returns and the like?
I think that's a great idea. It's on our to-do list to sort of think about small firms separately from large firms and if there are different dynamics. Based on how we've constructed the index, it's intended to sort of capture the broad market index, which mostly captures large firms. We think that's actually pretty distinct from the social media literature, which tends to focus and have most of its effects from smaller firms. So, like, if you think of like usually the return results that you'd see in a firm day sample would be mostly driven by the small firms. Whereas here, like our variation in sentiment and attention, it's market cap weighted. So it really captures like the broad market. And so we think that's more like, we think that's a good first index, but I agree, like looking at versions of this that try to capture sort of smaller firms would be very useful.
Yeah. And maybe the last one, I think this might also be an interesting one, would be to sort of the how consistent are the effects over time, right? So you have basically you have a time series that you look at, but you could also think, maybe these effects that you're showing are specifically driven by some of the more rare events, such as the COVID crisis or SVB or something. If you would, or now, if you would have that the 2025 Trump effect, so to speak. What if you, for example, exclude those? Are the effects consistent, or is this sort of like basically just suggesting, okay, there are some specific markets and or down markets in which these kind of effects are more present?
I mean, I guess this is one reason why we looked at the trading strategy and we kind of rolled the performance over the whole sample, is that it was pretty consistent throughout the sample. We have a version of it where we just kind of pick 100 random paths throughout throughout our sample period, and all those kind of point in like the same direction, and it doesn't look like it looks like a pretty pervasive relationship. But I think this idea of dropping certain subsets is a nice one, and we can do that as well.
Yeah. I think we need to stop here, at least for those who would like to log off, because it's basically already 6 o'clock. What I would do basically towards the end, just briefly nudging people to the final. Oops. Do I have that? Did I show the right one? Oh. Do I show this one? Do I show the yeah. Okay, thank you is also okay. But next month, we have a last webinar before we go into summer break with Sophia Kacinik from Stanford. Topic will be revealed very soon, as is going to be the discussant. So thank you again for joining. Thank you, Tony, specifically for taking your time here to present your paper and discuss this. And I hope you guys come back with even more research that you're doing in one of our next webinars. And I hope to meet you also in person at some point at a conference. Thank you.
Thank you very much.